Hey everyone, this is Dave Allison, president and founding partner of Prosperity Capital Advisors. And I want to walk you through a real quick high level overview of what's going on in the markets. I'm sure you've seen on the news, things are not going real well for the markets. We're off to the worst first three quarters that we've seen in a long, long time. And I want to walk you through some of the things that are impacting the markets, our portfolio, and some silver lining in it all, some things that we can be optimistic about into the future. And so I'm going to talk through this market intel exchange real quick. I'm certainly not going to cover every area, but the three big things that I know are on the minds of my clients and most of our investors are inflation, the Fed's policy and growth implications, and the midterm elections coming up. We all know inflation has continued to skyrocket. We are now starting to see a small downward trend in inflation. We're even starting to see it as we get out into the streets and we're buying goods and services, but it's not enough to make markets happy at this point, and it's certainly not enough to make the Fed happy. The Fed needs to do everything they can to get inflation under control, and they've been incredibly hawkish on their position to fight inflation. They've basically said they're going to do it at all costs. And as you could imagine, the stock market does not like that. Now, a couple of things that could be some silver lining is that the market and the data that's driven around inflation is lagging. So again, it might not be today as bad as some of this data is reporting. I actually think if you look back historically, it probably even underprojected it. If I go back to this slide here and we see 9.1 at the height of inflation, I'd be willing to bet if you really added up some of the main components and drivers of inflation, we actually saw more than 9.1. But I think as long as we continue to see this downward trend, my hope is that the Fed does not get too aggressive at some of these future rate hikes. If they do, that can continue to put some uncertainty into the stock market and the ability for companies to forecast out some of their expected earnings and the discounted value back to stock prices today. So again, it's going to be a wait and see game on what the Fed does. They're projecting another 125 basis points of rate hikes through this year. But beyond that, the market expects to remain higher for a longer period of time, just hopefully not a lot more than what we're anticipating. A couple things that I want to share too is the midterm elections approach. One thing that we might be able to be a little optimistic about, and now again, history does not always have to repeat itself. But if we look at all years of the stock market that are not a midterm election year, we typically saw the stock market go up in value up until the time of midterm elections, and then we actually saw it go down. But in years we see a midterm election, we actually have seen historically the average of the stock market go down leading up to elections. And then we've seen a rally. They've called it the midterm election rally after polls close. And so hey, even if history doesn't repeat itself, even if it rhymes or it's close, I think we would all agree we'd be happy with some sort of increased market value or rally to try to close out the year. This slide provides a little more context to that. It shows every midterm election year going back to 1950. And you go look at some of these impressive numbers. 1819 midterms, 1 year after the market had delivered 11.7%. You could go back and look at the worst 1 year period after a midterm election year was 86-87. The market delivered 1.1%. Now, if you look at the averages, again, over 1 year, 15.1% average return versus all other years that there was not a midterm election, about 7.1%. So there's some interesting viewpoints out there. You can go and take a look at this infographic, but about half of the perspectives say we're going to see about 8 more hikes through 2022 and 2023. About 40%, 47%, less than half of the group thinks we will enter a recession in the next 12 months. The positive of that, the glass is half full. 53% say we are not going to enter a recession in the next 12 months. But the average that do think we will enter a recession say it should last about 7 months. Who knows? Maybe we're in one right now. Ranking in order of the things that would have the largest positive impacts on equity markets, we start with the Fed policy. Like I said, if they start to see inflation trend downward, they might slow down their interest rate hikes. That would be a positive move for the markets. If we started to see inflation come under control, that would be a positive move for the markets. If we start to see supply chains open up, we'd probably see a positive move for the market. And if there's positive movement with the Russia-Ukraine war, some of the geopolitical risks become reduced, that would ultimately be positive news for the market. When we look at the overall economy, these are some key economic and market metrics. Consumer sentiment is below the normal range, but increasing. Economic growth is around in the average or normal range, but it looks like it's on the decline. Inflation, as we all know, is above. Volatility is towards the top end of a normal range. Unemployment is still towards the bottom end, but we see that arrow ticking upward now. It's something we'll be keeping a close eye on. And then the 10-year Treasury is still actually at some low ranges in the kind of normal range that we would see that U.S. Treasury as about 3.83%. A couple other areas that I just wanted to touch on real quick as we look at equity markets. I love this slide. This slide basically talks about the fact that since 1929, we've seen 26 bear markets. The stock in those downturns have lost, on average, about 36%. But if we look on the flip side of it, stocks gained 114% on average during bull markets. As you can see from this picture, these bull markets have typically lasted a lot longer than the bear markets do. Think about it. If I gave you the option of losing 49% in turn then to have the trade-off of positive 101, down 57 for positive 404, down 34 for a positive 114 like we were through COVID, you could look at these downturns, and I think most of us would agree, while we'd love to figure out a way to avoid them, they are inevitable when it comes to investing, and this downturn is not going to be any different. I think what you start to see is there's some asymmetrical risk that there's a greater chance we're going to go up from here than we are going to go down from here. What I mean by that is the S&P 500 or the markets through the first 3 quarters are down about 25%. There's a chance it could go down 30% or 35% or even 40%. So maybe 5, 10, 15% from here. But there's a higher likelihood that we're closer to the bottom than we are to the next top. And so that's that asymmetrical risk that really helps pay off for investors. And so as we go through and we embrace some of these opportunities, the two last pieces I just wanted to share with you. One is on overall diversification. Our portfolios hold both international and domestic positions. Again, there's no crystal ball when one is going to outperform the other. If we look at the decade of 2010 to 2020, domestic U.S. stocks outperformed. If we look at the decade of 2000 to 2009, international performed. If we look at 1990 to 1999, domestic performed, and in 1980 to 1989, international performed. So where are we now? There's no telling. None of us have a crystal ball that can predict if domestic is going to outperform international or international is going to outperform domestic. But it just goes to show the importance of being diversified. The last component that I just wanted to share was just a couple things from an overall asset allocation perspective. We're coming off some historical market returns. If we look at 1976 to 2001, we were in a generally decreasing interest rate environment. We saw a typical 60-40 diversified portfolio. What that is 60% is U.S. stocks, 60% is U.S. bonds, returned about 10.91%. If we look at some of the expectations of some of the largest asset managers in the world, JP Morgan, Goldman, BlackRock, State Street, they are projecting that the 60/40 portfolio over the next 10 years is going to return around 5.3%. You can see what their consensus was on stocks and on bonds. And where this is very important is we're thinking about projecting out financial plans for our clients in retirement, right? The old way, the historical returns might say that, hey, on a diversified portfolio, maybe we could expect almost 11%. And I would challenge any advisor who's illustrating that going forward. I think we need to be more conservative and realistic, agree with some of these larger institutions at the headwinds as we're in a more increased or elevated interest rate environment. The last thing that I want to show is this response to volatility, because there's no doubt we are in an incredibly volatile market. And your response to volatility matters immensely in your portfolio. I want to talk you through a story of 4 investors. We're going to start with the apprehensive investor. In 2009, they panicked when the market fell, and they moved to cash at the start of 2009 and remained there. Well, what you could see is they started with 10 grand. They lost during the financial crisis. They panicked and moved to cash, and they never did anything. Well, their ending balance by being invested in cash was about $6,151. They locked in that loss and they never recovered. The uncertain investor moved to cash at the start of 2009, just like the apprehensive investor did, but they got back in the market 1 year after the crash. And so what you can see in gray is this investor started with 10 grand. They got out of the market after the crash. They waited till things settled down. They got back in the market, and now their 10,000 doubled to $26,070. The steady investor stayed the course the whole time. They put their 10 grand in 2008, and they never did anything to their portfolio. They never made any changes. They never sold the cash. They simply held on. And here we are in 2021, and their value would be $32,000. Last but not least, this is outstanding. The opportunistic investor. They started with 10 grand, and then they saw the markets fell like they did during the financial crisis. And they said, you know what? This could be a once in a lifetime buying opportunity. I'm going to invest another 10 grand at the start of 2020. And by simply doubling their investment when the market was down, look at their value today, $85,587. This is when I mentioned tremendous wealth can be built in these market downturns. Think about it. You put in $1 million, and then the market goes down. You put in another $1 million. Think about what you'd have, or 100,000, or 25,000, any dollar amount. It still is relative to the fact that when markets are down like this, it could be an opportunity for investors that have additional capital. If not, it at least shows the value of being a steady investor. Maybe you're retired. Maybe you don't have a lot of capital set aside to be able to invest in a downturn, but everybody has the opportunity to be the steady investor. And so I, again, would encourage everyone. We don't know what market outlook is going to be going into the fourth quarter here. There's a lot of uncertainty. There's some positives. There's certainly some headwinds. But I would challenge everyone, as difficult as it could be the steady investor, be the opportunistic investor over the long haul. You will benefit from it immensely. Thanks so much. If you need anything, please reach out to us or our team. Reach out to your advisor, and we are happy to help talk you through some more of this data and how it relates to your portfolio.